Hello and welcome to a brand new show of Market Makers. 2014 has been a great year, a super year for Indian markets on all counts. But 2015, will the picture be different, or this is just the beginning and good times are here to stay? So to understand the macro setup, to get a flavor of valuations, and also to understand what are the key global concerns for calendar year 2015, I have the perfect man. Neelkanth Mishra of Credit Suisse. Neil, good to have you back. Thank you for joining us. I guess my introduction was the question in itself. 36% of our benchmark indices this year. Where do we go from here now?
I think we go higher. We go higher for very different reasons from what I see my peers or other analysts talking about. I think there is too much of a focus on intrinsic drivers in India. So there is too much of navel gazing and what we can achieve, what reforms can happen. I think what is happening outside India is actually far more exciting in terms of new information and analysis. The world is struggling for growth. So the growth in 2015 is expected to be only marginally higher than the anemic numbers in 2014. In fact, the fears or the renewed fears of deflation are a clear sign that there is a clear growth problem in the world. Now, in this environment, it is very likely that the monetary environment globally will ease further. So there's been a fear for almost a year and a half now that the monetary environment is going to tighten. Far from the case. The amount of QE in 2015 could be twice the amount of QE in 14. If you look at the policy rates in 60% of world GDP, it's at 0.2%, it's almost zero. And now a lot of other economies are cutting rates as well. In this environment, any economy that can show growth will get a higher multiple. Any stock that can deliver 15% plus earnings growth can continue trading at very high multiples. Given that India's nominal GDP growth in 15 is going to be the highest in the world in dollar terms, nearly 11-12%, what that means is that India will continue to be the favored market globally. And even companies that are trading at say 25 times, 30 times earnings, you will see investors flooding into them because they really have no options. So that's, I think, the reason why the market will do well, where the multiples maybe inch up slightly. I mean, it's not very high multiples anyway. The premium to the world price to earnings is not very high. And I also think that earnings will grow at maybe 12%. So over 2 years, we think the market can deliver about 30% returns.
Okay, I'll get into specifics of India, but let's understand the big picture. And the big picture is that India, which was part of the Fragile Five exactly a year ago, now is the only source of growth. Is that an enviable position to be in?
It shouldn't be surprising. See, this is where I think we end up using the wrong benchmarks. Let's start with the definition of EMs. I mean, BRICS is, I think, such a useless phrase that or an abbreviation that I think it's not worth even discussing. But let's start with EMs, right? Emerging markets is effectively like mid-caps. In a research team, you'll say, okay, you analysts, you do banks, you do tech, you do consumers. And okay, so whatever is the rest, you do mid-caps, right? Emerging markets, I think 15, 20 years back was something like that. That you do Japan, you do US, you do Europe, okay, you do emerging markets. Now for 20 years, if you put Mexico and Brazil and India and China and Russia in the same bucket, everyone thinks they're comparable, but they're not. India is like a sub-Saharan African economy. When Mexico was at India's current level of prosperity in 1976, Brazil and Turkey were at India's level of prosperity in 83. They are far, far ahead of India. India has to solve some very basic problems, like half the households that use firewood for cooking, like the fifth or the fourth of households that don't have electrical connections, the 1 lakh villages which don't have roads. These are the problems to solve, and we'll keep growing at 5%, which the world will envy. It is also a far more mature market. It's a very stable political system, and a political system which, because of what we have seen in the last 6 months, is now becoming very, very growth focused. So you're finding chief ministers, who I think matter actually a lot more than people give them credit for, are now becoming a lot more responsive. They're building the railroads, they're electrifying households, they're providing drinking water. And I think those are things that are keeping India India's prospects for the medium term very strong. So I wouldn't be surprised that India is growing faster. Right?
But the problem for Indian stocks could be that India is more like a discovered story. At a time when emerging markets in general have got outflows, Indian markets have got inflows.
Correct.
Do you think the biggest risk for Indian markets going forward could be that we are a crowded trade, we are an over-owned market, and incremental flows may slow down?
I don't think so. See, I think so there will be some structural changes in how money gets allocated, right? We are already seeing that the same fund, which has an EM fund and an India fund, the India fund is getting massive flows, but the EM fund is not getting any flows.
Is that true?
Yes. Okay. So what's going to happen is that, and we obsess too much about FIIs. And we look at, EM funds are the max overweight in India they've ever been. So what, right? All institutional investors that we talk to, our clients, their discretion is in what stocks they choose, not the timing of fund deployment. Because if they get inflows, they will deploy funds. If they get outflows, they will redeem, right? Now, the eventual saver is the sovereign wealth fund, the pension fund, the insurance fund. And the more you talk to them, the more you realize that they all want to raise their India weights. So there are funds that will tell you, as per our current AUM and the current target weight for India, we should be having $2.5 billion in India. Right now we have 300 million.
Oh, that's it.
Yeah, but this is not going to happen in 1 year. Okay. Because see, choosing a country, increasing a weight in the country means that you want to see sustained performance. If they come in, they're going to come in for 15, 20 years. They're not coming in for 1 year. So that decision, which vehicle to use, which fund manager to choose so that they can allocate funds. So all of that takes time. So this will be a slow and steady increase. So I'm not too worried. But I do think that fund flows next year will slow.
Global fund flows.
Yeah, into India will be worse than what we've seen this year. And there is a reason for that, which I think most people don't seem to be thinking about, which is lower commodity prices.
Okay.
See, if you think about trade and capital flows, there are two sides of the same coin. So just like we had a large current account deficit, which is getting addressed by low oil prices, there was a country with a lot of large current account surplus, which is also getting wiped out because of the weak oil prices. Now, all of these economies almost all of these economies used to have structured flows. So if they got $1 billion of flows in a year, 30 million would come to India. If they got 100 billion, then $300 million come to India. Now, that flow is going to slow. Our estimate, and it's very hard to quantify these flows, but our estimate was that nearly half of the flow coming into India was these what you would call systematic investment plans, that X% goes into India, X% goes to Japan, Y% goes to Japan.
Typical ETF money.
ETF money. Not just ETF, it could be through active funds as well. Because these guys have to decide, do I want to go through ETF or do I want to go to a hedge fund or a long only? Now, so that flow I think will stop because that saving is gone. That saving is getting transferred to maybe Europe. So the new current account surplus is going to come from Europe because Europe's oil import prices will come down. Now, do they have the same mechanisms which say Norway had or Abu Dhabi had or Qatar had or Saudi Arabia had? That money will automatically flow to India? I'm not so sure. Maybe that will take time to evolve. So in the interim, you will see that $18-20 billion a year of equity flows fall maybe to $10 billion a year. Now, which is not bad. But the flows will stop now, slow. Now, there is a further risk which is of a disorderly market correction.
What do you mean by that?
See, so far, if you see market volatility globally, sitting in India, it seems like it's the world's rosy place. The market's doing well, the currency is stable. But there are markets, large markets. Brazil entered bear market territory yesterday. In dollar terms, there are several markets which are down 15 to 20% in the last 2 months.
China has been extremely volatile.
China has been volatile as well, on the upside so far, but there are lots like, say, Australia, Brazil, Russia. These are markets, or Saudi Arabia, Nigeria, all the commodity exporting countries have seen corrections. Now, so far, it has been exactly what the doctor would have ordered, right? So these are commodity exporters, the market should sell down. What happens if oil prices are down $40 from where they were is that leverage starts to play up, right? And that leverage could be in a company, that leverage could be in a fund, that leverage could be in a bank, And once you see a disorderly collapse, so then the dominoes start rolling, right?
What we saw in 2008, more like a chain reaction. So you were not ruling that out. 2015, we could see a chain reaction in other asset classes.
Yeah, so there could be 2008 is a very scary example to give, so I would not go that far. But yes, I think there is a problem.
Something of that
nature, not that magnitude.
On lower magnitude. Yes. Fair point. So let's talk about your portfolio strategy. Between your last 3 strategy reports, even though the India outlook, the macro, the global environment, commodity prices, everything has changed, your key overweight and underweight positions have not changed.
Yes, they haven't. I would not call it laziness or inertia. So
that's your thought process.
That is the deliberate. So some investors also tell us that your model portfolio doesn't change. But it's not because you're not working. I mean, I think it is because we're putting thought into it. And
you're really working. I have struggled to get time for an interview.
So I think an economy like the size and diversity of India doesn't change very quickly, right? And it doesn't follow calendar year or even fiscal year or whatever, right? I mean, there is a certain trajectory. When I look at consumer companies, I mean, I think there is a fair bit of skepticism about high valuations. But I think, given what's happening in the rest of the world, even if you're showing 15-20% earnings growth, I think people will love you for that. And I don't think being squeamish about valuations at this stage is the right thing. I also think that Western benchmark, Western approach of viewing consumer companies as defensives is not correct, because I think that these are growth companies. These are not 3% growth companies. These are 15-20% growth companies, and that growth is not coming just from volumes in the categories they're in. It's also coming because they're expanding categories, they're expanding distribution, they have some pricing power, and they have margin expansion coming from lower commodity prices. So all of that means that the earnings growth for these companies can actually be quite reasonable. Discretionary, I think the story is even stronger, because it is about penetration. See, in the last 4 years, we've completely forgotten all of those nice charts about how India, this category is underpenetrated, that category is underpenetrated. Because there were 2 tail risks that had emerged, one on the currency and the second on the government, that the government couldn't solve any of the problems. Second, that whatever gains you had would be wiped out by the currency. Now, if you have a stable currency and you have a government which is quite capable of solving crises if and when they come, you can take a longer term call. And I think, so discretionary also is something. I think exports, we have a structural advantage. I mean, I think I myself was shocked. I mean, I must tell you that I thought that intake capacity of engineering colleges in India was 1.4 million, and I thought that was a big change over the 650,000 that we had in 2007. As per the Ministry of HRD annual report, that number now is 2.8 million.
Which means demand for IT engineers is very strong.
Supply of IT engineers is very strong.
Okay, which will keep the wage inflation down.
Correct.
Is that the reason why you're bullish on IT?
One of the reasons. The second reason is that on the demand side, IT is changing so dramatically.
Whether it's Mac, whether it is digitization, whether it is cloud.
Yes.
So technology is moving up and they're moving up the value chain.
They are, and every company will be forced to change its IT. You will be forced to change its IT. CS, I mean, investment banks are spending massive amounts of money upgrading in their IT systems, trying to keep up with the changing demands for valuation from our clients, from the more complex trading systems, keeping up to date with how employees need to collaborate among themselves. All of these things require massive amounts of investment.
But what happens if currency is not on their side? IT companies have seen a robust margin expansion because currency was on their side.
Correct.
Rupee has gone from 45 to 62 and margins have not expanded dramatically. But if rupee goes from 62 to 55 or even 58, margins could contract.
So this is where, so earlier the USD INR used to be a good benchmark to follow. I think the RER is given what's happening to the companies, the currencies elsewhere, perhaps the RER. I mean, so we have depreciated against the dollar by 3-4%, but we have appreciated massively against every other currency. So RER is actually at a 10-year high. It's at 110 now, the real effective exchange rate. So the currency has been extraordinarily strong already. And that's going to show up in the dollar revenue growth that and that market may actually fret a bit, but that's like a 1 quarter, 2 quarter issue. What I distinctly recall is my call in about 2 years back when we were very bullish on IT because we were worried about the currency. And we thought that the currency was at 53, 54, we thought it's going to fall. And we were very constructive on IT, and that was the only sector that year which got where it downtraded. Basically, the P multiples fell down. Now, why did that happen? Because dollar revenue growth had started to shrink, right? So the market, I think, sees through the translation impact of earnings. See, what is price to earnings? It's what you would call sustained earnings growth, right? If it is a translation effect, it doesn't really lead to a PE re-rating. It leads to so what matters is dollar revenue growth. Now, you can ask if the companies are going to grow at 14, 15%, should they be trading at 25 times earnings? And that's an argument I think is a fair argument, a fair opposition to what we are saying. But where I think a lot of IT companies are not at that multiple. There are some they are. So
only 1 or 2, I guess.
But secondly, coming back to where the world sees growth, I think those multiples are not going to come down. So we may worry about that, okay, if this is going to be in 3 years' time, it's going to be a 13 times, 14 times earnings company, 13, 14% growth company, and it's going to trade at 13, 14 times, then for the next 3 years, I'm going to see no return. So that's an argument I've heard. I don't think that's going to happen because the world is so short of growth and liquidity is so easy and there's so much of QE happening.
You want visibility and predictability.
Correct.
Okay, another interesting call is that you still like private banks, the HDFC banks of the world. Looks like you're not convinced that PSU banks will make a comeback.
I think it is remarkable how frequent this question of NPAs have bottomed. This every 3 to 6 months we hear, oh, NPAs have bottomed now, right? NPAs have bottomed now, every 3-6 months. They haven't. I think the concern I have is if China keeps doing what it is, a lot of the metal companies are in deep trouble.
Yeah.
And most
metal,
of them,
textiles, lot of other commodity suppliers would be in deep trouble.
And many of them are very heavily leveraged.
So that's one visible concern.
That is one visible concern. Second, I think the coal issue, if the auctions are successful, right? So a lot of people think, oh, auctions are done, great reform, right? I'm glad at the pace at which the government has responded. I think they should be given credit for the fact that they've responded at that pace. It's a very complex problem. If the auctions are successful, we are back to where we were in August, when the Supreme Court first decided that these allocations were illegal. There is a fair chance that they won't be successful, right? What that means and what I mean by successful is that what is the definition of success, right? The success is if your coal output or outlook for coal output is the same in March, on March 16th, as it was in early August, right?
Which may not happen.
Because what is going to happen is that some company could actually win a coal block which it cannot evacuate coal from. Now, there are people assuming that block is so far away, no one is going to bid. No, this is a 30-year lease. If it takes 3 years,
18 months to set up the infrastructure.
Exactly. So they will still bid for it. And if they win, there could be a 12 million ton block or 6 plus 6, so some large blocks, which could not produce for 2 years because the buyer cannot evacuate coal.
The other sector where you are bearish on is telecom. The spectrum pricing is not out, and hopefully this time some reasonable or rational bidding could be done. Are you bearish on telecom because of Reliance Jio, or you think structurally telecom is an old story now?
No. I think our fears are completely about the competitive entry of a very large player.
Okay.
And what it does to pricing of data, what it does to pricing of voice. I think those are
valid concerns.
Yeah, and so even when we got negative, we were completely aware that the companies are seeing pricing power after a long time.
Because data usage has gone up, voice usage has gone up.
Yeah, so I think so the sector is, in terms of just the earnings momentum, is actually doing extremely well right now. The overhang of competition is something that worries us.
Okay, one question from my side, then I'll move on to the Twitter question. Why are you bearish on industrials? Because if economy is on the mend, industrial activity will pick up investment cycle will revive. And the first port of call in any reviving economy is that you go and buy early beneficiaries or cyclicals.
No, so we are actually of the same mindset that you buy early cyclicals, but the industries are not early cyclicals, they are late cyclicals. So you first need to see utilization reach a certain level. It is only then that people start doing fresh capex. And I would say that the market's already priced in the recovery. Some of these stocks are trading at 25, 30 times earnings. Right?
Some of them are actually at a record high also.
Yeah, and they are trading at multiples where consumer companies are trading. So the recovery is priced in, but I don't see that happening anytime soon. I mean, I don't see the industrial cycle, the large-scale industrial cycle, recovering for the next 2-3 years. But the markets have already priced it in, which is what worries me. So I think it's a premature optimism that worries me. Some of them
is optimism.
They are some of them are very good companies, and I know that they will survive, and I think they'll do well and thrive as well.
Maybe it's too early to buy them.
Yes.
Okay, I'm just going to take the Twitter question. The Twitter question for Neel is coming from Rahat, and you're popular on Twitter. What Rahat wants to know is that the biggest risk for markets going forward could be liquidity, because we have QIPs, government FPOs, IPOs. Is that a valid concern, and do you think 2015 managing liquidity could be a challenge?
No, I don't think so. I think the issuances, I'll tell you that the world is desperate for growth. Every single big saver in the world is scouting for opportunities. It is up to us to create and provide vehicles to them to invest. If we can create something on railway that this track or this part of the business is firewalled, and if you invest here, all the revenues come to you and you will get a guaranteed return or something, or not a guaranteed, I mean all the returns that you get from this, you will get truckloads of money.
So fresh paper, don't worry about it.
I won't worry about it at all. I mean, so long as it is positioned rightly, I think it'll sell. I don't think the liquidity is that big an issue. The paper issuance can create technical problems because all that money cannot come in at the same time. But so for a few weeks, few days, possibly. But I don't see that as a big overhang, because 2015, and this is where I think the world's positioned mentally for tightening, because the US Fed gets a lot more publicity than the BOJ or the ECB. Now the ECB is actually outdoing them a bit, but what they're ignoring is that the ECB was shrinking its balance sheet in 2014. The LTRO money was coming back. If you recall, 2011 December LTRO had started.
Now tables have turned.
So now in 2015 they're going to be expanding their balance sheet.
Always, lovely interacting with you. Thank you for your time and thank you for joining us.
Thank you.
That's it on this edition of Market Makers. Thank you for watching the show, and thank you for following us on Twitter.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.